Welcome to the Deep Dive. Today, we are strapping in for a bit of a high-speed tour. We're going through some seriously dense, but I think you'll find incredibly revealing financial literature.
Oh, absolutely. This is the good stuff, the real mechanics.
It is. We've secured the most recent comprehensive source material. We're talking the annual report, key compliance filings, all from a major, globally significant bank. And this captures their entire performance and risk profile as of, well, late 2025.
And these documents really are the ultimate peek behind the corporate curtain. They're not the glossy marketing materials. These are the filings that go straight to regulators and investors, laying it all bare.
And our mission here is pretty straightforward.
Mm-hmm.
We want to give you the shortcut. We're going to cut through this mountain of data to extract the most crucial bits of knowledge.
Mm-hmm.
So what was the true financial performance for 2025? What are the governance structures they have to maintain? And maybe most importantly, where are the big risks concentrated right now?
And I think this material gives us such a unique perspective because it's really the collision point. You get to see how global economics, things like, persistent inflation or a trade policy in the U.S. and Canada,
Right.
how they clash head on with these deep, unforgiving regulatory regimes. We're talking Sarbanes-Oxley, Basel III for capital. It's just a fascinating synthesis of macro trends meeting that institutional reality.
Okay, let's get into it. Let's unpack this financial scorecard, starting with the headline numbers. This is for the year ended October 34, 2025. Now, on the surface, the growth looks fantastic.
It does.
Total revenue for the year just soared to $37,741 million.
Wow.
That's a huge bump up from $33,670 million in 2024, a $4 billion increase in revenue in 1 year. That's impressive top-line momentum.
It is impressive momentum, but if we're doing a deep dive, we have to look deeper than just the top line.
Of course.
And this is where the trend gets a little more complicated. If you follow that revenue all the way down to the bottom line, net income attributable to equity holders, it saw only a slight, almost incremental increase. We're talking about moving from $7,758 million in 2024 to just $7,789 million in 2025.
Wait a second. So revenue jumps by over $4 billion, but net income barely budges.
Barely.
If I'm hearing you right, almost that entire new chunk of revenue just evaporated somewhere on the balance sheet.
Mm-hmm.
That seems alarming. Where did it go? Is that sustainable?
Well, the source material confirms exactly what you've intuited there. That massive revenue growth was effectively eaten up. And it happens mainly through two channels. Rising costs, specifically their non-interest expenses, were up sharply.
Things like salaries, tech investment.
Exactly. And critically, higher provisioning for credit losses, we'll get into that later, but is a huge signal of increasing stress on their loan book.
And I guess we see the ultimate pressure point reflected in return on equity, the ROE.
Right. The efficiency metric.
Right, how much profit they're generating from shareholder capital. And that number actually dipped to 9.7% for 2025. That's down from 10.2% the year before and 10.3% the year before that.
So it's a trend.
It's a downward creep, even with record revenue. That seems like the clearest signal of some kind of profitability pressure.
It is. But despite those underlying issues, you have to say shareholders had a very strong year. Purely in terms of price return and dividends, it was great. The closing market price per common share jumped to $91.99 in 2025.
Wow, from what?
A significant gain from $71.69 in 2024.
And that translated to a really healthy total annual shareholder return of what? 35.7%?
Just about, yeah.
Yeah.
So while the bank is dealing with these efficiency issues internally,
The stock market loved this story.
the stock market loved it. And for anyone relying on income, the dividend stability is just key. They paid out $4.32 per common share in 2025, up a little from $4.24, and they've already approved another reliable $1.10 quarterly dividend.
And when you think about the scale here, over 1.2 billion shares outstanding. That stability is a massive draw.
A huge draw.
Okay, so let's pivot from the numbers to the structure that's supposed to keep all those numbers honest. Shifting into governance.
This is where you see the sheer institutional rigor required to run an operation this big.
The central body for all of this, for integrity, is the Audit and Conduct Review Committee, the ACRC.
The ACRC.
They're the frontline defense against any kind of financial misstatement or regulatory breach.
And what's fascinating in the material is the sheer concentration of designated expertise on that committee.
Right, this isn't just a formality.
No. To comply with exchange standards, the bank specifically identifies 4 members as independent financial experts. The list includes Benita Warmbold, W. Dave Dowrich, Aaron Regent, and Stephen Van Wyck.
And that's not just about having seasoned executives. It's about having people with deep, specialized financial accounting knowledge who can truly scrutinize these filings.
And their mandate is just enormous. It goes way beyond a routine audit.
Oh, yeah. The ACRC is responsible for compliance, anti-money laundering, AML controls, anti-terrorist financing, sanctions. It's a huge portfolio.
So it's a huge relief for them, I imagine, that the source material notes that management and the external auditors, KPMG, confirm that the bank's internal controls were effective as of October 31st, 2025. That's a huge stamp of approval.
A required stamp of approval in this post-Sarbanes-Oxley world.
Okay, but here's where it gets, I think, really interesting. This shows the teeth of modern regulation hitting executive compensation. I'm talking about the clawback rules.
The clawbacks.
They've adopted this firm policy requiring the recovery of, and I'm quoting, erroneously awarded compensation.
And that's a direct consequence of recent SEC rulemaking.
Yeah.
The power of this policy is just immense.
So what's the trigger?
It's very specific. The bank must prepare an accounting restatement because of material non-compliance with financial reporting requirements.
And if that paper, that restatement is filed, what's the actual consequence for an executive?
If that trigger is pulled, the bank is mandated to recover all incentive-based compensation.
All of it.
All of it. Received by executive officers during the 3 completed fiscal years, right before the date the restatement is required.
Wow. So it turns accounting integrity into this massive personal financial liability for the senior leadership.
Exactly. It shows how seriously regulators are taking the numbers now, long after the money's been paid out. Makes the audit committee's job even more high stakes.
Okay, let's move outside the bank's walls for a minute. Let's look at the external economic context that shaped 2025 and is really setting up 2026. The bank's own forecasts seem to anticipate a pretty difficult landscape, especially in North America.
Indeed. Their U.S. outlook is for continued sluggish growth. They're projecting 1.9% in 2025, slowing even more to 1.6% in 2026.
And they see weakness where?
They note clear signs of weakness outside the highly visible, high-growth tech sector, and they see a worryingly persistent inflation rate.
And their prediction for the Federal Reserve is very telling, isn't it, about how they see the economy's path?
It really is. They anticipate the Fed lowering rates by another 100 basis points in coming months.
A full percentage point.
Right. It signals that they believe the central bank will have to react pretty aggressively to a broader economic cooling.
And Canada, of course, being so closely tied to the U.S., doesn't escape the pressure.
No. Expected growth here is even weaker. They're forecasting 1.2% in 2025 and 1.4% in 2026.
And they explicitly link that to the U.S.
Directly. They attribute it to the indirect impact of a softer U.S. economy and, maybe more importantly, the direct drag from U.S. trade policy and tariffs.
So that's a clear geopolitical headwind translating directly into economic drag. So we've got slow growth regionally, but the bank also has to deal with these unexpected shocks, and not just economic ones.
That's right. I mean, they highlight the raw power of nature hitting their international branches.
Right.
When you look at the international operations, the source material notes that economic activity in Jamaica and the Dominican Republic was measurably affected by Hurricane Melissa.
And a storm like that doesn't just stop commerce. It leads to insurance claims, slows down loan repayments.
It messes with all the provisioning models, absolutely.
And speaking of international complexities, there's this major ongoing legal battle with a sovereign nation that just highlights the scope of their global reach.
It really does. The bank is vigorously pursuing arbitration against the Republic of Peru.
This is at the ICSID, the International Center for the Settlement of Investment Disputes.
Right. And it stems from a prior legal action. It involves a substantial financial provision, $142 million, that they recorded back in 2024 related to default interest.
It's just a reminder of the risks of operating globally.
And it's an interesting contrast, though, because while Mexico's being weighed down by those U.S. tariffs, the bank notes that Peru and Chile are actually holding firm. They're benefiting from strong global prices for copper and gold, so their international performance is really a mixed bag.
Okay, so let's shift now to the core business of banking, lending, and specifically the credit health of their customers.
This is the sharp end of the risk analysis, and there is a key metric flashing red here.
And that metric has to be the non-performing assets. Gross impaired loans increased substantially.
They did.
They hit $7,244 million as of October 31st, 2025. That's up from $6,739 million the year before. That's almost $500 million in increased stress in just 12 months.
And this increase wasn't confined to a single market, which is telling.
Right.
The rise was driven by new formations, that just means new loans going bad, in both their Canadian commercial and retail portfolios.
The mortgages, unsecured consumer debt.
Mortgages, unsecured debt, yes. And at the same time, they saw formations rising internationally, especially retail customers in Mexico and Chile. It points to a pretty broad-based economic stress hitting consumers across their footprint.
Which raises a really important question, given their massive exposure to residential real estate in Canada. I mean, we are talking about a staggering $370.2 billion in total residential mortgage and home equity lines of credit.
And this is where we have to look at the crucial underlying risk factor, leverage. The Canadian residential mortgage portfolio is predominantly uninsured. It sits at 77.3%.
Uninsured, which means the bank, not the government, takes the full hit if the borrower defaults.
Right. If the property value doesn't cover the loan, it's their loss.
So if the loan is uninsured, the loan-to-value ratio, the LTV, becomes absolutely critical.
Exactly. The LTV measures the debt versus the asset's value. And the average LTV for that uninsured Canadian portfolio increased to 54%.
Up from 51% in 2024.
That 3-point jump means borrowers have, on average, 3% less equity buffer than they did a year ago.
So if the real estate market falters, say, by 10 or 15%, that LTV gap shrinks very, very quickly.
And it exposes the bank to much greater loss severity on a massive portfolio.
And if the LTV ratio is a risk indicator, then the geographical concentration is like a risk multiplier.
For sure.
Over 55.5% of their Canadian residential mortgages are concentrated in Ontario alone.
So any shock to that one regional market will have these huge outsized consequences for the bank.
But despite all this rising credit risk, it is vital to acknowledge their capital strength.
Oh, absolutely. Their Common Equity Tier 1, or CET1 ratio, was 13.2% in 2025.
And just to remind everyone, that ratio measures their core equity capital against their risk-weighted assets.
And 13.2% is exceptionally strong. It's well above the typical 10.5% regulatory minimum required by OSFI, the Canadian regulator.
So they have a significant capital buffer to absorb those rising credit losses if that pessimistic scenario materializes.
That's what it's there for.
Right, and that capital buffer is critical because it's designed to absorb expected losses, which brings us to the sophisticated accounting required under IFRS 9. This isn't just about accounting for the past, it's about forecasting the future.
That's absolutely right. IFRS 9 mandates expected credit loss, or ECL, modeling. Before, banks typically only provision for losses after a loan had already gone bad.
The incurred loss model.
The incurred loss model. IFRS 9 forces them to look forward and estimate losses over the life of the loan right now, based on forward-looking economic forecasts. It's an enormous change.
So how do they structure that complex prediction process?
They use a 3-stage model for credit risk. Stage 1 is for assets that are still performing well. That captures the 12-month expected loss. Stages 2 and 3 capture lifetime expected losses. Stage 2 is for assets showing a significant increase in credit risk. And Stage 3 is for assets that are already impaired.
And to run these models, they have to rely heavily on management judgment for specific inputs.
Precisely. The core inputs are, subjective, the probability of default, or PD, the exposure at default, EAD, and the loss given default, LGD.
So they have to project what percentage of a loan they'll actually lose if a default occurs maybe years from now.
Exactly. And their forecasting uses multiple potential futures, which is a key part of IFRS 9's mandate.
Right. They don't just bet on one outcome.
No. They rely on 4 probability-weighted forward-looking scenarios: a base case, an optimistic one, a pessimistic one, and a very pessimistic scenario. Their current provisions are based on the weighted average of all 4 of those potential economic worlds.
Interestingly, when they back-tested their non-retail portfolio for the period ending July 31st, 2025, the actual losses they experienced for both PD and LGD were lower than what their risk parameters had estimated.
Which suggests the models are intentionally maintaining an appropriate level of conservatism. They're baking in buffers to protect themselves.
And that conservatism seems to be reflected across the board. Look at their trading business.
Okay.
They reported positive daily trading revenue on 100% of trading days during 2025.
Every single day.
Every single day, averaging $16.3 million per day. And their primary market risk metric is the value at risk, or VAE.
Okay, so what does that VAR number actually mean for someone listening?
So VAR averaged $8.9 million per day in 2025, and that's at a 99% confidence interval. Put simply, it means that on 99 days out of 100, they are confident they won't lose more than $8.9 million on their trading floor.
It's a key metric for limiting exposure to sudden market shocks. And for an institution this size, that number is relatively low.
And finally, we see their positioning on interest rates. A sustained 100 basis points, so 1% increase in rates across all major currencies would actually benefit them.
Really?
Yeah, it would increase their pre-tax net interest income by about $236 million over the next 12 months.
So even though they're forecasting rate cuts in the U.S., they are strategically positioned to gain if global rates happen to stabilize or rise unexpectedly.
Okay, so what does this all mean for you, the well-informed listener? I think the source material reveals a banking giant that's, well, successfully managing the complexity of modern finance. They're achieving these significant regulatory milestones like the strict ACRC oversight and enforceable clawback rules, and they maintain very strong capital buffers.
Uh,
But at the same time, they are clearly facing rising tangible credit risk. You can see it in the increasing impaired loans and that higher LTV ratio in their massive uninsured Canadian mortgage portfolio.
The final takeaway for me is just the sheer intense effort that is now required to model and really monetize risk itself. The reliance on this complex IFRS 9 modeling, demanding those 4 probability-weighted scenarios to calculate expected credit losses. It just shows that the modern financial world has to turn potential future failures into present-day mathematical provisions just to exist. Risk isn't something they avoid, it's something they meticulously calculate and price.
And that brings us to our final provocative thought for you to consider. Given the detailed disclosure on their macroeconomic forecasts, specifically the U.S. anticipating 100 basis points of rate cuts and Canada's slow growth being dragged down by tariffs, what might the actual unmodeled ripple effect of these simultaneous global shifts be on those domestic retail loan formations we saw rising? What happens to credit quality, particularly in that concentrated Ontario mortgage book, when the pessimistic scenario they modeled actually becomes their reality? Something to consider as you navigate the economic outlook for the coming year.